Welcome to Making Money. This is Matt McCall. Thanks for joining me. We got a big show coming up. We got a guest coming on that doesn't really view the world and the market in the same lens I do, but that's great. We want to have different views when we do this show. We're bringing up Jim Rickards. He's the editor of Strategic Intelligence. He's also director of the Jim Rickards Project. You probably heard his name. He's been in business a long time. He's been skeptical of a lot of things the government's done, of the Fed, big gold bug. So we're going to talk about that. We're going to talk about what the Fed's been doing as of late. We're going to talk about gold, where he thinks it's going. No brainer here. He thinks it's going higher. We'll talk Bitcoin and markets. All that and more coming up right now on Making Money. Over 1 million people around the world follow Wall Street veteran Mark Chaikin for his shockingly accurate stock market predictions. He just gave them a dire warning. Mark says we're about to witness an historic stock market shakeup that can soon create devastating losses for investors who don't know what's coming. And as a result, you only have 90 days to move your money. You see, Mark spent 50 years on Wall Street at some of the most prestigious hedge funds in history. And he's been on Fox Business and CNBC countless times. But this is a financial story no one else is telling. And if you let this take you by surprise, you could be in for a world of pain. He explains everything in a brand new free report available at rollingcrash2023.com. He includes a name and ticker of a popular stock that could be directly impacted by what's happening as well. Mark warned of the beloved pet brand Chewy before it fell 45%. Tech company C Limited before it fell 66%. Furniture company Wayfair before it fell 76%. Social media favorite Snap before it fell 36%. And food delivery company DoorDash before it fell 65%. Mark even called the Amazon crash before the FANG stock fell 35%. So you'll want to avoid the stock in this new report immediately. Again, simply go to rollingcrash2023.com for your free copy of this new report. All right, so here he is, Jim Rickards. Jim, thanks so much for making your first appearance here and Making Money. It's been a pleasure to get you on here.
Thanks, Matt. It's great to be with you.
So let's talk about really what's going on here in the market recently. And of course, we had a third major bank failure. What's kind of your view right now on where we stand in this, if you want to call it a banking crisis, and kind of where we go from here?
Well, third major bank failure is one way to put it. It's actually the fifth or sixth, depending on where you start. Most people go Silicon Valley Bank, Signature Bank, First Republic, and that's right, three big ones in a row. But before Silicon Valley Bank, there was the failure of something called Silvergate Bank. And Silvergate was interesting because it was an FDIC-insured member bank, a regular bank in that respect, but it was a portal to the crypto world. It was a bank that exchanged crypto for dollars and held crypto accounts, et cetera. And then that failed on March 9th. Silicon Valley failed on March 10th. Signature Bank got whacked on March 12th. So a lot happening very quickly. And then a week later, on March 19th, we saw Credit Suisse in a shotgun wedding with UBS, orchestrated by the Swiss National Bank. That's one of the biggest banks in the world. It's been around for about 150 years, so not under the direct jurisdiction of the Fed. Although with these European banks, I mean, people don't realize most of their operations are in the U.S., so you end up, in effect, being regulated by the Fed. But yeah, that was orchestrated by the Swiss National Bank. And now we have First Republic. And First Republic was, you could see it coming. I think the market reaction was muted precisely for that reason. I mean, it was a dead man walking on March 10th, but they got a $30 billion lifeline from Goldman Sachs and Morgan Stanley and Citi and Wells Fargo and, the usual suspects. And that was just to give them liquidity. It wasn't a bailout. There was no new equity there. It was just some cash. But then that failed a few days ago. So now the headlines today, of course, say, well, thank goodness the banking crisis is over. The Fed solved the problem. The FDIC has guaranteed all the deposits. And they did. Actually, all the deposits at First Republic, Silicon Valley Bank, Signature were fully protected beyond the $250,000 insurance limit. That's the law, but who cares, right? So they just guaranteed all of them. The Fed actually bailed out every bank in the system to the tune of trillions of dollars by agreeing to buy U.S. government securities at par even though they were worth 80 cents on the dollar. So if you had 80 billion of securities, the Fed would give you 100 billion as a loan against that pledge. But it's nice to get loans for more than your collateral. But that's what they did. And that's system-wide, so that could be in the choice. So the headlines now are Fed solved the problem, FDIC rose to the occasion, crisis is over. That's completely false. That is what everyone's saying. That is how the stock market's reacting. This banking crisis is far from over. All the dominoes never fall at once. They fall sequentially, and sometimes there are time gaps between them. And everyone says, "Oh, all good." It's not all good. You have to look behind the curtain of the international monetary system, understand what's actually going on. These failures are symptoms more so than the real problem. The real problem has to do with tight money. And interest rates are 5%. They're going to be 5.25% soon. At least that's the target rate for Fed funds that the Fed sets. But that is a year or just over a year ago, March 2022, they were zero. So you go from 0 to 5.25% in about 1 year. That's extraordinary. I mean, people remember Paul Volcker raised interest rates to 20%, and he did, but that played out over a couple of years. This is 5% in 1 year, and the Fed's not done. I mean, they're saying we're going to think about it. We want to look at more data, but they have not said we're done. This whole pivot narrative has been wrong for a year, and it's wrong now. So we have tight money. We have underwater bonds. We have bank management who don't know the first thing about risk management. If you knew anything about risk management, once the Fed said, "Hey, we're gonna raise rates until we kill inflation," and that is what they said. Jay Powell gave 8 speeches between the summer of 2022 and recently, and he said that every single time. Well, if you're a bank risk manager and you hear that, you're like, "Huh, I got bonds. Interest rates go up, bond prices go down. I understand they're unrealized losses unless I sell them if they're in what's called a hold to maturity account, but they're still losses." And it still destroys confidence. Now, bank runs today, you don't have to line up around the corner in the rain, with your hat on, waiting to see the teller. You can just do it with your iPhone. And to the tune of, you can move $1 billion with your iPhone if with the right accounts and passwords and all that. And so that's what happens. So the bank runs are instantaneous, and they're far from over. So yes, a little, kind of we're in a quiet period, but there'll be more. And a good analog, Matt, is the 2008 financial crisis. Everyone remembers, September 15th, 2008, midnight on a Sunday, Lehman Brothers files for bankruptcy. And that's true. But that started in the spring of 2007 when HSBC reported disappointing earnings based on mortgage losses, and then came to a head in August. 2 Bear Stearns hedge funds failed. There were high yield mortgage funds at the end of July, August. The Fed raised the discount rate. It took a full year, another 13 months, to get to Lehman Brothers. And what happened along the way? Bear Stearns in March 2008. Fannie Mae went bankrupt in June 2008. Freddie Mac bankrupt in June 2008. Congress bailed out the system in August 2008, and then Lehman Brothers. So that took a year and a half, and there are a lot of crises like that. So we're in falling dominoes. It's not over. It'll get a lot worse, and people should prepare for that. But as usual, they don't. People are very complacent. Wall Street says it's all good, and people believe it, but they shouldn't.
Yeah, and so we're taping this on Tuesday, so we'll air on Thursday, so right before the Fed. But it's basically written in stone that they're going to raise interest rates 25 basis points.
Sure.
But the action here on Tuesday is a bit interesting to me, Jim, because you would think the headline is, okay, we got past this banking crisis, like you just mentioned. However, the KRE, which is the regional bank ETF, down here midday Tuesday over 7%. We have some of the big names in there. PacWest down, losing a third of their value in one day. Western Alliance down over 20%. So you're seeing some of these other banks that have been mentioned in the same breath as the ones that have already failed, getting crushed even more. So it tends, I let the market tell me what's happening. I'm not smarter than the market. This action is telling me there's still more to go with just what we're seeing purely in the market.
Yeah, and Wall Street. I mean, one way to understand it, I think of the banking system as the marlin in The Old Man of the Sea. And once the sharks smell blood or detect blood, they just keep eating until it's devoured, and they just go bank to bank. So all the action was aimed at First Republic Bank. That's over. It's now stockholders got wiped out, bondholders are getting wiped out, depositors are protected, et cetera. So the sharks just look for another fish, and they trade systematically against the target. So what's been happening is the big banks are getting bigger. J.P. Morgan, Wells Fargo, Citi, Morgan Stanley, Goldman Sachs, Bank of America, a couple others are the big seven. They have a lot of little local banks. I have some money in a bank that was started in 1877. They're doing fine. Nobody thinks they're systemically important, which is a good thing. Very well managed. But in between, you have what they call these regional banks. They're big, and they're not nearly as big as the J.P. Morgans of the world, but they are too big to fail. But they do fail in the sense that they get become insolvent, get taken over by the FDIC, and then the FDIC has to bail out all the depositors with taxpayer money, by the way, using the FDIC insurance fund. So we're far from done. I agree with you. It's I don't want to name names. We all know who they are, but these are, when you say mid-size, okay, mid-size, but you're still talking hundreds of billions of dollars of deposits and assets. They're not small by any means, and they are too big to fail. I don't care what Janet Yellen says. I don't care what the FDIC says. If one of these things actually failed, in the sense that they had to shut their doors and depositors were not protected, if that were the outcome, you would see a banking crisis worse than 1931. I mean, it would be horrendous. So they can't let that happen. And by the way, don't lose sight of the fact that we're approaching another presidential election. I know it's it's not till November 2024, but the New Hampshire primary is less than a year away, and the debates are going to start this summer. And so, except for Biden, he can't debate, but and everyone else running for president will. And so the point is, this has enormous political impact for the Democrats. Probably helps the Republicans, bad for the Democrats. And don't think the Fed doesn't read the papers, as the saying goes. So they're going to do, and Janet Yellen's going to do. By the way, Janet Yellen doesn't understand anything about what we're discussing right now. She knows nothing about monetary policy. She knows nothing about fiscal policy. She's a statistics geek and a labor economist from Berkeley. Kind of an affirmative action hire, et cetera. But she doesn't understand what we're discussing. She doesn't understand systemic risk. She understands political marching orders. And so you're right about these regional banks being targeted, but they're just going to go one by one by one. And it'll, with the risk that somebody decides to draw a line in the sand and that's a mistake, or two or three happen at the same time, the panic becomes more generalized. And then we haven't even talked about the international banks, Deutsche Bank or UBS or UniCredit or Santander, Barclays, all the big, again, European, UK banks. So you're right. It's far from over. The next victim is being teed up right now as we speak, and Wall Street just keeps going. It's very. It's one thing when the markets are bad and you're kind of caught in the crossfire. It's another thing when the market systematically trades against you. And that's what I saw in 1998, long-term capital management. So, it's 25 years ago. So you got to be probably, if you're under 50, you may not have a real good memory of that, but it happened. And we came within hours of shutting every market in the world before that bailout got done. And as I say, I negotiated that from the LTCM perspective. But the point there, August was a generalized liquidity crisis. We were affected by it, but so was everybody else. But September, it became systematically against long-term capital management. It was like, okay, we're just going to trade against you. We don't care where it ends up. We don't care if spreads reverse. For the time being, we're going to trade against you until you're dead. And that's how Wall Street works. And we're getting to that stage. You mentioned a few names. You're right. There could be other ones, but they're just going to go bank by bank. It's almost like a sniper versus, machine gun fire. And so it's far from over.
So, I guess two questions coming off that. You mentioned the big banks, Bank of America, JP Morgan, et cetera. JP Morgan, to me, got one hell of a deal with First Republic. I mean, the backing of the FDIC, obviously some things in there, getting money backing them up. They came out and said on Monday that it adds $500 billion to the bottom line immediately. They got some of their deposits back that were in there. They helped prop them up. Right. So it seems like they got one hell of a sweetheart deal. So do you think, there's two questions. One, will the beneficiary of this be the large banks such as JP Morgan, Bank of America? And you talk about, doing the sniper one after another. When does that end, though? I mean, at what point, what ends that?
Well, it either ends when, well, it can end two ways. One is something like 2008, but worse, just a generalized global financial crisis where everybody's getting the money out of every bank, either buying treasury bills. Treasury bills at a brokerage firm are pretty safe because it's not about the brokerage firm. Brokerage firms fail all the time, but they have to segregate house fund, proprietary funds, and customer funds. Customer funds have to be strictly segregated. This is why John Corzine was, pariah, because he commingled them with that MF Global situation about 10 years ago. But they are kept as segregated accounts. That is audited and enforced. And so when a brokerage firm fails, they just take your account, all the accounts, and they just move them over intact to a solvent broker, and then life goes on. So nothing's risk-free, and there have been exceptions, but generally, treasury bills in a segregated funds in a brokerage account are safe because they'll just be moved. Either the broker will be fine, or they'll be moved over to another broker. Money market funds, same thing, in the sense that in 2008, the government proved that they're willing to bail out money market funds. I mean, and they did, guaranteed every money market fund in the country. So the best safe haven is gold. I say physical gold, bullion, coins or bars, and silver. It's not digital. You can't hack it. You can't steal it, and you can't freeze it. They just put it in a safe place. So, but Americans don't really get gold. They don't really understand it. So, yeah, I think it's just going to be a question of frog hopping from lily pad to lily pad, looking for a safe place. The other scenario is that the government just throws in the towel and says, okay, all deposits are guaranteed in unlimited amounts. I mean, I knew people who were trying to get $8 billion out of Silicon Valley Bank on that. They sent the wire instructions on Thursday night. One guy I talked to said, hey, Jim, from Thursday night to Sunday, we didn't know where the money was. We sent the wire instructions. We were trying to get it out, but we didn't know what the outcome was going to be, whether it was insured or not, the wire sent or not. And then Sunday night, the Fed and the FDIC came out and said, all good. We're going to, business as usual, open Monday, and it's all good. And he said the money went through. But that was what, people were facing, and they'll continue to face. I mean, the banks you mentioned, I don't know what their deposit flows are right now, but my guess is they're shrinking fast. People are getting their money out. And so you might just have to give a generalized blanket deposit insurance protection, and that would stop bank runs in theory. But then now you basically nationalize the U.S. banking system. You look like Argentina. So there are no, I guess the way to put it, Matt, there are no good outcomes. Either there's a catastrophe worse than 2008 that starts to look like 1931, 32, or the government offers so much protection that they've de facto nationalized the banking system. One just quick note I would add, I think when it comes to banking crisis, I'm a little bit of a magnet for trouble. I remember the Hirschstadt Bank collapse in 1974. That was a foreign exchange crisis. But through the early 80s with the Latin American debt crisis, and the late 80s with the S&L crisis, and then 1994, the Mexican tequila crisis with the collapse of the peso, 1998, long-term capital, .com, 2007, 2008, we talked about that. And today, and when, October 19th, 1987, the stock market fell 22% in one day, not a year, but in one day. So I've been on the front lines of all of those. But the one thing I've noticed is that each crisis gets bigger than the one before, and each bailout is bigger than the one before. And the question I'm asking as an analyst is, are we at the point where the crises are so big, it's bigger than the Fed? In other words, we're not really talking about bailing out a bank or a sector. People lose confidence in the dollar itself. And we do seem to be heading in that direction.
All right, Jim, so you make a great point. I'm glad you brought up the dollar, because obviously dollars had one hell of a year into end of last year, pulled back since 2023 off that high. But I'd love to get your view on the dollar, and if the reason you believe gold is going to be stronger is a weaker dollar one of the catalysts you're looking at, Jim?
Yeah, I mean, you can think of the dollar and gold as kind of two sides of the seesaw. One's up and the other one's down, and then vice versa. when people talk about the price of gold, it's really the dollar price of gold. You can think of gold by weight. So, yeah, a strong dollar usually means a lower dollar price for gold, and a weaker dollar means a higher dollar price for gold. And we've seen that dynamic play out in recent months. It's not the only driver of gold, it's one of them. There's a good old fashioned supply and demand. I think in a bank, sometimes you see in a financial panic, gold and the dollar will both get stronger. The dollar will get stronger against other currencies, and gold will get stronger measured in dollar terms because there's a flight to quality. Get me out of, yen or yuan or rubles or euros or whatever else it might be. Get me into treasury securities. And the thing about a flight to quality, it plays out in security space. What you want to get are really treasury securities. You want to get really short-term treasury bills and treasury notes. But to do that, you need dollars. If you're a foreign banker, foreign investor, and you want to buy some 4-week treasury bills, you got to get dollars to pay for them. So the rush into safe treasury securities creates a demand for dollars. And then at the same time, gold is another safe haven. So sometimes it's the seesaw. Sometimes they can both go up at once. I guess what I'm really saying is that I see gold getting stronger. The dollar is very much in the news. It's one of the questions I get most frequently. You talk about Ukraine or China or inflation, all that, but it usually comes back pretty quickly to the dollar. But I find there's a lot of confusion on the topic. And the confusion comes from the fact that everyone talks about the end of the dollar, the dollar's going away as a global reserve currency, et cetera. But people don't distinguish between the role of the dollar as a payment currency and the role of the dollar as a reserve currency. And those are two very different things. There's some linkages, but payment currency, basically, if I want to buy goods and services from you, and I tender some form of currency and you're willing to accept it, and you're confident someone else will accept it from you, that's a good payment currency. It could be dollars, it could be euros or yuan, or it could be Russian rubles or Brazilian reais or anything, as long as people are willing to accept it, have confidence in it. And when we were kids, we'd use baseball cards and bottle caps. So almost anything could be a reserve currency. You need payment channels, and there's a little more to it than that, but that's basically it. A reserve currency is a very different thing. First of all, we don't really have reserve currencies. You go to the People's Bank of China, they don't have $100 bills stacked up in the basement. What they own are U.S. Treasury securities, which are digital, by the way. The last paper Treasury security was issued, I think, around 1979. So what they have are actually securities. So when people say reserve currency, what they really mean is securities that hold your reserves denominated in a currency. So, of course, Treasury securities are denominated in dollars, but they don't have actual dollars, in a bank account or a physical form. They own securities. Now, as far as the payment currency is concerned, that's relatively easy to displace. This is what all the news is about. So Saudi Arabia is talking to China about accepting yuan in exchange for Saudi oil. Brazil and China just negotiated a major agreement where the Brazilians could pay in reais for Chinese exports, manufactured products, semiconductors. The Chinese can pay in yuan for Brazilian, sugarcane, soybeans, aircraft, Embraer, and oil and other products from Brazil. The BRICS, that's Brazil, Russia, India, China, South Africa. About a third, we're close to half the population of the world when you throw in India and China in the same group. They've now rebranded themselves as BRICS Plus. So when they have their meetings, they're inviting Iran, Turkey, Argentina, and a lot of large countries, important countries that were not part of the original BRICS. They're working on a new payment currency, and that we're likely to see a big rollout of that this coming August. Don't know exactly what it'll be. They're working behind the scenes. It could be commodity backed. It could be gold backed. I'm not predicting that, but that's certainly one of the possibilities that we need to look at. But again, these are payment currencies. Now, when you get over to reserve currencies, it's much stickier. It's much harder to displace the dollar as reserve currency because it's not really about the currency, as I mentioned. It's about the securities market. Who has a securities market that's big enough, liquid enough? I mean, you need all maturities of securities from 4 weeks to 30 years, 10-year notes, 5-year notes, 2-year notes. You need primary dealers. You need an underwriting group, which is what the primary dealers are. They also make markets. You need settlement, clearance, distribution, custodians. You need hedging devices, when issue trading, repos, futures, options, et cetera. You need that whole network. We've been building it for 230 years since Alexander Hamilton, and no one else has it or anything really close to it. Maybe the Germans and the Italians, but they're not really big enough. So the point is, and above all, you need the rule of law. I mean, nobody trusts the Chinese, nobody trusts the Russians with their money. So, and they don't even have large sovereign bond markets anyway. So the dollar kind of wins the reserve currency, meaning really securities, crown, because by default, there's nothing else that can compete with it. And there won't be soon. I mean, the things I described take 10 or 20 years to build. And again, the rule of law is probably the most important one. So you're not going to see the dollar knocked off as a reserve currency, so-called, by other currencies or other bond markets. But there is one thing that could knock the dollar off, which is gold. Gold is just gold. If you have physical gold, bullion or coins, you don't need all that other stuff. You just put it in a safe place and guard it, like Fort Knox or whatever the Russians and Chinese have their equivalents, and just sit on it. It's not digital. You can't hack it. You can't freeze it, etc. So if someone said, so the idea of the dollar losing ground as a payment currency is completely plausible. It'll happen in stages, and it's happening already. The idea of the dollar losing its role as a reserve currency, it's not going to lose it to another currency, but it could lose it to gold. And part of the reason for that, I always say that foreign countries can't really destroy the dollar, but we might do it ourselves. In other words, through U.S. policy blundering. And we've done that. I teach a course on this at the U.S. Army War College, and I tell the class, we have weaponized the dollar to an unprecedented degree. It's not just a currency or a store of value or the denomination of a securities market. By kicking Russia out of SWIFT, freezing the reserves of the Central Bank of Russia, which is the 12th largest economy in the world, blocking them from, freezing accounts, et cetera. All these other countries are watching, China, Brazil, India, the countries I mentioned. They're asking themselves, gee, what if, Janet Yellen gets out of the wrong side of the bed and doesn't like what we're doing? And what if they sanction us? They just did it to Russia. Maybe they'll do it to us. So the way I describe it, if you hit the punching bag enough times, the punching bag gets up and walks away. And that's what's happening. It's not that the dollar isn't a good channel of payment. It generally is. But if you're going to weaponize it and punish countries with it, then that's a pretty good reason to get out of it. So again, I think U.S. policy is doing more to hurt the dollar than what foreign countries are doing, but it's happening nevertheless. But the big winner could be gold.
I want to thank you for explaining the difference between reserve currency and payment currency, because that a lot of times people meld those two together. Because yes, there are headlines about payment all the time. I mean, on social media, all the stuff going on. I think last week there's 20 some different large payments that were done overseas with the BRICS Plus and their potential currency. So I'm glad you did that, because we just had a meeting last week with all of our analysts down outside Baltimore, Maryland, and just the debate going on about the dollar. And then finally, somebody had enough sense to stand up and say, listen, it's not losing its reserve status anytime soon. I don't care what you say, what you think, what's happening, not in the next decade. It's just not happening. One thing I didn't hear you mention, Jim, and I don't know your view on this specifically, and you may not have any view on it, is Bitcoin. Do you have any view on that as the digital gold, as some people call it, as not a replacement for a dollar by any means, but a store of value potentially?
Yeah, I've done an enormous amount of work on Bitcoin. I don't own any. I don't recommend it. I think it'll end up at zero. But I know people who bought some Bitcoin. They bought a couple thousand Bitcoin at $2 or $3 and sold it at 20,000 and paid their taxes and walked away with $20 million. So those stories are real. But I've also seen the data and research studies that show that more people have lost money in Bitcoin than have made money. The winners are highly concentrated in relatively few hands. So it's mostly a losing game. I've come up with, and I know a lot about it. I get accused of being, you're a Neanderthal or a dinosaur. You don't understand technology. It's nonsense. I'm on the board at Florida Institute of National Security. We're the third fastest supercomputer in the world. We're working on AI applications for national security. I read Satoshi Nakamoto's paper 11 years ago when it first came out. So I understand it perfectly. But it's taken me a long time to figure out what it is. I mean, I know the math, I know the algorithms, I know the blockchain, but what is it really? And I've come up with two theories. One is the way you can think about it. I go into a casino, put $5,000 on the roulette table. The croupier gives you $5,000 worth of chips. You can gamble them. You might make money, you might lose money, et cetera. But at the end of the evening, What you can't do is go out in the street and buy dinner with the chips. You have to go to the cashier and get your money and dollars and then go out in the street and buy dinner. In other words, there's a crypto world. It's pretty big at this point. It's got, exchanges, custodians, thousands of individual coins, futures, hedging devices, etc. But it's all in this one casino. It's in the crypto world, and it's not good for anything except for gambling, which is what chips are good for. And then if you want to get out, you got to go through a portal and get dollars. By the way, that's why the FDIC shut down Signature Bank on May 12th. Signature Bank was no different than 1,000 or 2,000 other banks that had underwater bond portfolios. I mean, Barney Frank was on the board. He said, why didn't you just let us be until Monday? We would have survived just like all the other banks that are also underwater. But the answer was they had a facility, a portal called Signet, which was a channel to the crypto world. And that's why the Fed shut them down, because the Feds, at the same time that they're bailing out banks, as usual, and trying to get rid of cash, and pushing the central bank digital currencies, they're also trying to destroy crypto, and that was one step in that direction. The other way, it's a little more sophisticated. You need to be pretty immersed in communications theory, but cryptocurrencies are really hallucinogens. Everyone sees what they want, and it goes their way. So, but I mean, it does have ramifications in terms of post-literate, post-linear world. But that goes back to Plato and Aristotle. It's a bigger subject. Maybe we can cover that on another day. But I think at the end of the day, they won't be worth anything. But I know people have made millions. That's true.
Yeah. All right. Before I let you go, we do the island question on the show for every guest, and you have the option to answer it. If I were to send you, your family, your friends, maybe you want to go alone to an island for 10 years, put down your phone, which I would love to do for the next 10 years and not look at the damn thing. And what's that one investment or investment class that you feel very comfortable with holding for the next 10 years? What opportunity you see right now?
Well, it's an interesting question. I just returned from an expedition to Antarctica, so we came pretty close to the island you're describing, because the internet was very sketchy. We didn't have it a lot of the time. It would be gold. Okay. By the way, I'm a big believer in diversification. You don't put all of your assets into any one asset class. I don't care what it is, but I'd have a significant slice of gold. Look, it's volatile. It's been up and down, and people get frustrated. Why isn't it at $5,000-$10,000 an ounce? I mean, it'll get there, but it'll get there very quickly. There's a basic piece of math, which is a fixed dollar increase becomes a smaller percentage increase the higher the value gets. So, for example, if you go from $2,000 an ounce to $3,000 an ounce, that's a 50% increase. But if you go from $9,000 an ounce to $10,000 an ounce, that's only an 11% increase. And it's the same $1,000. You still made money, but it gets easier. So that's why when these things do take off, 3,000, 4,000, it could go to 10,000 very quickly, because each increment is a smaller percentage and therefore an easier hurdle to clear, even though you still make the same $1,000 an ounce. So, so what I advise people is, hey, what are you waiting for? Why don't you get the gold now while it's reasonably priced and available? The time may come when the price is to the moon. But worse than that, you won't be able to get it. I mean, you won't be able to get it at any price, at least not physical gold. Call a dealer. I mean, I have gold dealers. I mean, I call them now and they say, well, Jim, I'll work the order and get back to you, but it might take a week or so. The Mint's not taking new orders. I mean, we're talking about the physical world. I'm not talking about ETFs, gold futures, and all the paper gold. I'm talking about physical gold and silver. There are shortages. So I would get it now while you still can.
So when it comes to that, do you in your personal, do you own the physical gold? Do you own some ETFs and stuff as well? Or do you stick to the physical gold?
Physical, because that's gold. Okay. I mean, an ETF is not gold. It's actually a share on the New York Stock Exchange.
Yeah. Okay. Well, thank you so much, Jim, for joining us. I hope you're wrong about some things. I won't tell you which ones I'm on the other side of, but it's great getting your perspective. And of course, I've been a big fan of yours for a very long time. So I appreciate you coming on the show, and hopefully I'll have you on again soon.
Thanks, Matthew.
Opinions expressed on this program are solely those of the contributor and do not necessarily reflect the opinions of Stansberry Research, its parent company, or affiliates.